Alasdair, in your latest Substack dated September the 9th, the headline read, Debt Funding, Inflation and Gold. There were some vital points. You mentioned good and bad debt, President Trump and his trade tariffs, America already in recession, massive inflation coming, and last of all, the American debt trap. Could you walk through these points to our viewers today?
Yes, indeed. The funding position is getting out of control. That is basically Besant's problem, Besant being the Treasury Secretary. You've got a combination of things happening here. On the one hand, you've got Trump's big, beautiful bill, which is adding to the overall debt pile. On top of that, there are increasing signs that the US economy actually stagnating and probably in recession. I would refer in particular to the recent unemployment numbers or employment numbers, which have been very disappointing as far as Trump is concerned. He sacked the head of the BLS a few weeks back, and he's now ranting and raving about the most recent releases, which was an enormous downgrade of previous numbers by something like 900,000 jobs. And at the same time, he is attacking the Federal Reserve and particularly Jay Powell. There is this situation where I think that the US Treasury is beginning to understand that they have got a funding problem. The slowing of the economy is very, very damaging to government finances because it means that there's less tax revenue coming in. I mean, this is not an immediate effect, but this will materialize, particularly in 2026. And also welfare costs will be increasing. So this adds to the debt burden, if you like. And at the same time, you have, if you like, evidence of a buyer's strike in the longer maturities. In other words, investors are beginning to take the view that the growth in the level of debt in the US is becoming unsustainable, and they require higher compensation for the risk of investing in long-term debt. Now, this contrasts hugely with the problems of a recession. I mean, the Keynesians look at recession and say, well, what recession means is that consumer demand falls and therefore prices fall. We need to have prices rising in order to encourage consumers to continue to buy. This is a load of rubbish because it all based on the idea that production continues as before and is not affected, if you like, by the change in consumer behavior. This doesn't happen. What happens is that production also declines because guess who is behind the production? The consumers who work in order to produce. So this is actually the reality of the situation. And what it means is that we can have a recession. In fact, with every deep recession, this is automatically true. We have a recession and we find that prices are rising at the same time. The big instance where this didn't happen was when the dollar was on a gold standard in the 1930s. And that basically prices were maintained in gold above what they would have been, if you like, if it was just a pure fiat currency. And this was why Roosevelt devalued the dollar against gold by 40% in early 1934. So the problem now faced by the Fed and the US Treasury is becoming intractable. This is a real problem. I think that the debt aspect of it is extremely important. At the same time as debt is becoming unsustainable, of course, the Fed is under enormous pressure to reduce interest rates. We have a situation where the markets expect an interest rate cut this month in September, in a few days' time, next week. And at the same time, they expect further cuts later on in the year. Now, that completely ignores the inflation outlook. because the inflation outlook is determined by the purchasing power of the dollar.
Mm.
At the same time as the Fed is cutting interest rates, which tends to reduce the attractiveness of the dollar, particularly to investors who are already concerned about the rising risk of too much debt. At the same time, you have President Trump calling for a lower dollar, along with Stephen Mirren, who is just getting appointed. He was the man behind the so-called Mar-a-Lago Accord, and he's just being appointed to the Fed. And my guess is that he would be Trump's nomination for the next Fed chairman. So looking at it from outside, you can see the dollar's going down. The dollar's going down because of growing political influence from President Trump and his fellow executives. This is not a good situation at all. Now, if you look at what happens in this case, the first thing we can see is that the trade-weighted index is in a bear market. And technically, it looks terrible. And you can easily project a further 10 to 15% fall in the value of the dollar measured against the other major currencies, principally the euro and to a lesser extent the Japanese yen. So that's one problem. The other problem is that we see that the gold price is rising, which more accurately described is actually not the gold price rising, though there's probably an element of it, but the dollar falling, or more importantly, perhaps an expectation that the dollar will continue to fall. So we have this situation where it's already difficult for America to fund itself. And at the same time, it's trying to cut the interest cost on the government, which basically will put off buyers even more. And we're not just talking about foreign buyers who own some $40 trillion of currency and underlying financial investments, including deposits, but we're also talking about the investing institutions, and particularly the major ones. And investing institutions such as pension funds, insurance companies, and so on and so forth, who would normally automatically be buying treasury debt. They will be going on strike. That is the prospect, because they will look at this, and particularly at this time of year. September is the time when committee meetings occur in these big institutions, these investing institutions, when they plan for their investment policy in the last years of 2025, and perhaps looking into the first quarter of 2026. They will be bearish on treasury debt. Now, there is also the implication here, which is a further concern, and that is that if you look at the equity market, that is wildly overvalued relative to the yields on long-term debt. Now, I have been producing a chart for some months now, which clearly illustrates that the level of the disparity in the valuation between equities and the long bond is over twice as high as it's ever been in the past. This is a recipe for a collapse in the equity market when the long bond yield starts rising again. Now, the thing to watch is when it begins to approach the 5% level. At the moment it's about 4.8, 4.9, something like that. But if it goes through 5% yield, then this is going to ring huge alarm bells in equities. And if you look at the equity market itself, we have obviously, if you like, a debt come credit bubble. And a lot of the credit expansion has been aimed recently at investing in assets. So that the expansion of bank credit has been to finance margin debt for people who think that equities are going up forever. And the last figures that we've had from FINRA indicate that this margin debt is in excess of $1 trillion now. In other words, it's increased fivefold in the last 10 years.
Jeez.
So when that happens, you can see, yes, this is a bubble in equities. I mean, it's quite simple. People are buying momentum because they think things are going up forever rather than value. And for those of us with in this game with a little bit of memory will remember this was exactly the situation in the dot-com bubble in the years 1998 to 2000. And if you go further than that and you read of historical bubbles, such as the South Sea bubble and so on, it's exactly the same thing. This is, if you like, a very human condition, propelled by greed rather than fear. And this is something which is important. It's exactly the same situation that we had in 1929. And between 1929 and 1932, the S&P, the Dow, lost roughly 90% of its value. Another thing propelling the equity market downwards at that stage was the Smoot-Hawley Tariff Act. And guess what we've got today? We've got President Trump's wonderful tariffs, which are all part of his Make America Great Again, but is basically destroying trade, international trade. It is dismantling very, very efficient supply chains, for example. The consequences of this have yet rarely to be fully understood, or indeed to be reflected in markets. But I would say that the combination of a wildly overvalued equity market and trade tariffs waiting to be tripped up by rising bond yields is going to be catastrophic. It's going to be catastrophic for the financial sector. And what it will mean is that equities held as collateral, of which we can see at least $1 trillion just in margin debt, and that doesn't include equities which are held as general collateral against other loans, say property loans, mortgages, businesses, whatever. That will get sold down. It'll get sold down because banks need to secure the value of the loans at a time of collapsing collateral value. So that will add to the downward element. On top of that, foreign investment in US equities is in the region of $15.5 to $16 trillion. That is enormous. Now, why are the foreigners there? They're there for speculative reasons. It's as simple as that. They may dress it up and say, well, we're diversifying into other markets. Yeah, fine. But when the chips are down, it's speculation, let's face it. So there are huge forces in the financial sector waiting to be unleashed when the long bond yield goes up above 5%. And at the moment, nobody recognizes this. Another factor, of course, is that when you get this rise in bond yields, this is going to trip up the whole of the corporate debt scene. And all those debt zombies who loved the situation back in 2020 when interest rates were zero, or in the case of the Eurozone and also Japan, negative, they're going to be refinancing that debt because, you take it out, sort of, let's say it's a 5-year loan, 5 years, 2020, 2025, whoops, we're going to have to pay an awful lot more. Are they sustainable? No, you're going to get massive corporate failures. The problem here is that the Fed and the US Treasury have set themselves up not just to be the lender of last resort, but the supporter of the whole system in the case of a systemic crisis or a financial crisis. The only way in which this can be salvaged is by the production of money printing, credit printing. Replace the contraction of credit in the banking system with an expansion of credit by official sources. What's that do to the dollar? Pushes it down even further. Yeah. So coming back to the current situation where everybody expects falling interest rates, this is a trap. Because the consequences of a collapsing dollar will be what they call higher inflation. In other words, prices will rise and rise and rise. Not because nasty capitalists are trying to protect their margins, but because the purchasing power of the currency, which you use to buy these products, is collapsing. So what we are likely to see is far, far higher rates of inflation in 2026 and into 2027 than anyone dreams possible today. And it's all part of, if you stand back from it and you look at the bigger picture, we got into fiat currencies in 1971. That was the way forward. This was the new world. Well, this is the end of the fiat currency system. We can see it rapidly approaching, and it's going to be interesting and very unpleasant.
There are 3,800 fiat currencies. Which ones are surviving? None.
Zero.
And that's what Darryl and I have learnt, that fiat currencies, there is not one out of 3,800 or more have survived. The only currency to survive is called money, and that is gold and silver.
So what would make anyone think that the dollar was going to stand up for the first time in 5,000 years?
Yeah.
Hardly.
Hardly at all.
It is. I've got to say, it is interesting that governments really don't learn from previous errors. They keep on making the same mistakes. You would think they would learn.
Short-term thinkers. Fiat currency might work in the first 20 years, but the rest of the time, it just builds up that debt and debt and debt until it just collapses. Yeah.